by Manie Screencast. So what comes in mind when you hear the words earnings management? You may be thinking it's something to do with controlling money. In that case, you are partially correct. Well, to be honest with you, earnings management is one of the most difficult yet most important accounting concepts that you need to understand in order to succeed in both business and accounting. Now, back to the basics. What are earnings? Remember that earnings are the profits of a company, and that a company's net profit is equal to its total revenues minus its total expenses. And remember that every so often, companies need to present to its stakeholders financial statements illustrating a company's performance over the period in addition to its current financial position. Stakeholders, particularly analysts and investors, look at the earnings to determine the value of the company. In preparing these financial statements, managers have the right to intervene, and this is what is known as earnings management. In other words, earnings management is a strategy used to deliberately manipulate the company's earnings so that the figures match a predetermined target. So to help you out a bit, let me show you an example. As you can see in these pictures, by using the diminishing balance depreciation method, this company only managed to achieve just over $5 million in profits, which is approximately half of what the company had expected, the $10 million. So now this manager is now pressured to manipulate his profit figure in order for it to increase. He could achieve this by changing the depreciation method he uses to the straight line depreciation method, as opposed to the diminishing balance depreciation method, so that the depreciation expense is lower, and that this results in the net profit that stakeholders want. So you may be thinking to yourself that this sounds illegal. Well, earnings management is not against the law, as long as it is performed correctly. You see, earnings management encompasses a range of practices, including those that are legal, ethical, and comply with accounting policies. Unfortunately, earnings management also encompasses practices which can be negligent, fraudulent, and don't comply with accounting policies. Managers that are greedy for large bonuses or want higher job security would undertake such practices. In these cases, those responsible can be charged, immediately having negative effects on the companies involved.